Good morning. It's February 8th, Thursday, half an hour before the market's going to open. Yesterday, we finally got a little bit of market direction to the upside, and today we want to see if we can get that going and get more momentum behind it. We had a whole bunch of companies report earnings, more on a broad spectrum now, so we'll see how that's affecting our futures. And it looks like not that much, mostly random. S&P almost nothing, Dow almost nothing, so basically flat on both of those. And then we've got our NASDAQ that's down a tiny bit, but random. It's only 10, 20 basis points. So we're still in the completely random region. We wouldn't call this bullish or bearish, just completely neutral. We have no indication from the futures market as to how we're going to go. Now, the ones that are actually slightly lower, even though we were saying they're non-directional, they are slightly lower. Well, actually, it would only apply to NASDAQ. And if it opens a little bit lower, that means the likely direction after the open is up towards the previous day close. And we could get momentum at some point during the day for it to continue to move higher. It just depends on how strong the bulls are. And they've been proving to be very strong over the last several weeks. So most likely, as long as there's nothing to change everyone's sentiment, it'll continue. So our expectation is slightly to the bullish side. What do you call it? 55 to 60, not a huge advantage over random direction. But in any case, that's what it's indicating. So let's see what else we can find out. We've been looking at TLT. Okay, TLT is interesting. We had it sort of an indecision bar. We had a doji candle right here. So we traded up to the EMA 8 and then all the way back down to the open, which created this flat open and close. So basically zero body candle right here. And now it looks like we're going to open below the last 3 days lows. So we've broken this sideways movement in the TLT. And as long as we don't trade up significantly, that is going to indicate that we might start going lower. We may hit a little bit of resistance in this MA 150, but the bond markets don't react as strongly to moving averages, at least not the 150. It might on the shorter term ones and the MA 200, the MA 50, but not the ones that we put in just to kind of fill space, which is the MA 150 and to a certain extent the MA 90. MA 90 is more of a stock markets indicator and it's not used as much as the MA 500 or the MA 50. So we're not going to put too much credence in these two, the yellow and the orange moving averages, but we could run into it today. And that brings us very close to this purple line. And if we break below the purple line, then that puts a lot of pressure on the NASDAQ. Timing wise, it seems like it could work out. We're only expecting another week or so of strength inside the NASDAQ and inside the S&P before we have risk of it pulling back or making correction again. So if this in the next week breaks below that purple line, that's just another reason for us to believe that that's going to happen. We also had weakness in the IWM. We had that red bar. It traded below. It closed just above the MA 50, but it was not able to even get its high above the EMA 8 or the EMA 20. So we've got some pressure building in the small caps. The small caps have not been doing anywhere close to what the larger caps have been doing. And we need those to pull back. We need those to flip around if we're going to have a true bull market. One thing I wanted to look at this morning was momentum levels. I haven't looked at that for a long time, and there's not that much else to look at right now. So we might as well see what we can figure out. We'll look at the VIX first. VIX is still very muted. It looks like we might have a little bit of a green bar developing today. That would indicate, well, it doesn't indicate anything. It's not of enough significance, enough size for us to really pay attention to it. I'll look at the CPC, put to call ratio. Put to call ratio is at 80, so neutral, no information from there. So we'll look at our momentum levels. Okay, the first one I want to look at is just the index itself. We've got 70% above the 200-day, 77% above the 100-day, 63. This 70% might be overdone. That's pretty high for a 200-day average. We're getting up there. We're not at extreme levels like we were back in February of 2021, but we don't cross up here, so into the 75 region that often. Right now we're at about 70, so there's still a little bit of room, and timing wise, that could work out again. Another week or two, it is possible that we might hit this 75 to 80 level, in which case there would be a lot of pressure for it to come down. So right now, we have multiple ways of looking at the markets that are all agreeing in terms of the picture that they're painting. So it looks like for a little bit, we could continue to move upwards. That's what everything is kind of confirming that there's at least maybe another week where we can continue to move higher. Now this looks really extreme. 97%. This is financials, 97% above their 200-day moving average, 94, 94, 74, 64. So this starts to drop into more reasonable levels, but normally the 50-day will lead the 200-day. So this implies, I don't know how this 74% developed. Is it moving up or is it moving down? Most likely, this had to come up and hit the 90s before this could hit the 90s. And this 50-day is on its way down, which is interesting. That means I'm getting momentum sucked out of that market. It just hasn't hit the 200-day yet. So let's take a look at that. 97 is an extreme. We're at 20 years. Let's just do max. Nope, 10 year. Okay. So it's definitely at an extreme level. We've only been up here a couple of times in the history of the tracking of this, which was all the way back to 2015. This is going to have to start moving downwards. We can see that we were able to stay here for maybe 4 months back in 2021. And we've been up at these extreme levels. So this is, I won't count it, even though it is pretty high. You can see that there was not that many times where we hit that high also. They tend to turn around over here as well. If not here, then way up here. So 1, 2, we're in our 3rd month here. This one lasted 1, 2, 3, 4, and then we started to move down. So it could stay up here for a little bit longer, but a more complete picture will be seen after we look at the 50-day. So it's coming down. This 50-day is very clearly coming down. It did hit in the night. It hit almost 100%. It hit almost 100% back in October. And you can see definitely that, I mean, you can't go beyond 100%. And it's obviously 100% is unsustainable. We touch it, come very close to it. It just comes right back down, which it did and is continuing. So what's the tendency after we hit these extremes? Down for maybe down to the 50% at least. 50, this down to 40. This one is not as high, but came down to 52. This one came down to 40. This one came down to 42. This one came down to 30. So it looks like we should very comfortably presume that if not in a straight line, but pretty much a straight line, we should be able to shoot down to 50. So it looks like financials are starting to lose momentum. That doesn't mean that they're going to come straight down right away. Let's take a look at the XLF. It's looking really, if I wasn't looking at momentum and I only looked at its chart, I would say this looks amazing. This looks really good. It looks very similar to the S&P 500. It started, so this is basically just mirroring the S&P 500. If we drew the S&P 500 on here, they would look like they're basically right on top of each other. You see that? This, I don't even know what to call this color, sea green line. They're basically doing the exact same thing with the financials just a tad higher than the S&P 500. So this is highly, highly correlated to the market. When the market comes down, financials will come down. if the correlation persists, but it's been persisting really well for at least a year, uh, for almost a year. So since last March, that correlation has been extremely high. So there's no reason for us to believe that that correlation is going to break anytime soon. It could after we get that drop or that pullback or correction. That's when we would expect a correlation to deviate because different sectors will start leading faster than other sectors and we'll start getting that deviation. But for now, on the way down, if all sectors tend to drop at the same time, so we wouldn't get that separation on the drop. It's when we get the bounce when we would see that separation. So financials looks like there's an opportunity for pairs trades. Some of them are continuing to be very strong, as indicated by the 200-day moving average number. And some of them are starting to weaken. So some of these are on a shorter term basis, they're starting to decline. So finding a pair in the financial sector is really interesting right now. At least it is to me. So let's take a look. You can see a lot of these top performing stocks, they're mirroring since November, or actually the stronger ones since October. They've been on this very consistent upward trend. So the top ones will be pretty easy. I kind of like Progressive. I kind of like CBOE. Progressive is trading up along its EMA 8. CBOE just bounced off its MA 50. That's interesting. So pulled back to its MA 50 and is starting to bounce. CBOE, Allstate looks very much like Progressive. One of these three, any of these three, really. So Allstate has been trending upwards actually since last August. So that's been actually, so has Progressive. Excuse me. So has CBOE. So they're all really strong. So far, I'm indifferent to all three of those in terms of which one to pick to the upside. And then we'll scroll to the bottom, see what we can find to the downside. Market access. This might have been really poor earnings report, in which case it might consolidate for a little while. So I would avoid that. What was that? MTXS? MKTX. Yeah, that was earnings. So I would avoid that one. Aon looks like it might be a decent short candidate. And really, what am I doing? I'm basing it off of the MA 50 right here. So I'm looking for ones that are below their MA 50, that broke below their MA 50, like this one, State Street. Very clearly sharp downtrend right here ever since December. So that has been going against the market for quite some time. Broke below its MA 50 and it's heading towards the MA 200. We're very close to the MA 200. It might bounce from there, but it could break right through also, since we are expecting those MA 200 numbers to come down. Something's got to break its MA 200, and it's more likely to be a weak stock that is already close to its MA 200 than it is one of these guys that are flying way above the MA 200. So I kind of like that one, which was State Street. I kind of like it Morgan Stanley as well. It bounced off of the MA 200 already. It's coming down to test it again. That's a little too fast of a drop for my taste, which is why it probably bounced off of the MA 200. Now we're approaching it more steadily. INVZ is right there. Same with PayPal. PayPal had earnings. PayPal. What is this? Okay. PayPal had earnings. The market did not like it. Huge drop downwards. And it looks like at the open. Unfortunately, that's not tradable for us at the moment. It might become tradable in the next few days. But of course, we've already missed that gap right there. So let's go back with Morgan Stanley or IVZ. IVZ. So in option strat, what I can do is I can't build a pair, but I can build two positions and remind myself that they're a pair. If I build a long call with CBOE, let's just say, and go out to, we don't have an April, we only have a March. CBOE looks like it probably has wide spread, so let's not use CBOE. Let's take a look at Allstate or Progressive. Let's do Allstate. So if we do April, we can just do the at the money, the 160, the one that shows up right away. That would be a $620 investment. And let's take a look at what IVZ would look like. April 15 call, $75 investment. So eight of these against one of the, oh wait, this is a call. We would want to do a put on IVZ. So 5, 6, 7 of these against a long call in Allstate. So let's say, let me save this trade. Paired with ALL. And what I can do, just to confirm I've got a good pair, is I can check their correlations. There's a few ways to do this. I can do betas, I can do beta delta, or this is a little bit faster and easier to just check a correlation. So I'll just check the correlation. And what I want to do is take a look at Allstate and IVZ. And what I find is that Allstate and IVZ are negatively correlated to each other, which is perfect, and at about 77%. Generally, well, at least in terms of a pair, you can go either way. You're looking for either highly correlated or highly uncorrelated. You don't really want something in between. So highly correlated, I would say 80 and above. 77 is pretty close. I would call it close enough. And then uncorrelated would be 55 or 60 and below. So actually, and then I would just call that 60 and below. So we have correlation. So what that means is that if one goes up, the other will go down. That's great. At about, at least on average, in the last 20 days, the other will move about 77% of the other one. So if I go up in Allstate $1, or no, I shouldn't say $1, 1%, then I would expect IVZ to go down 0.77%. On net, assuming the same deltas on the options, what that should mean is that I make 0.23% on the spread. On the underlying, the options will multiply that by about 4 to 10 times, 3 to 10 times. So to make the math easy, we'll pick 10. So if I, in a single day, if Allstate moves up 1%, I would expect to make 2.3% on my spread. That's how it's an estimation. It's not perfect, but it's an estimation. It gives me an idea of how this might go. And then if IVZ goes down 1%, then I'll make about 2.3% on that spread as well. So if they're completely uncorrelated, then what will happen is if Allstate moves up, I don't know what IMVZ is going to do. It could move up, it could move down, it doesn't really matter. But what happens is I'm more concerned about a downward move. I am counting on Allstate to continue moving upwards. I'm counting on Invesco to continue moving downwards. That would be a deviation. That would mean that my correlation is intact. One goes up, then the other has the opposite. I have negative correlation. So if one goes up, the other one should go down. And we would actually make more money on the spread that way, faster, if each one continues along its path. If one starts to go, if there's a market event that starts to shove our correlations together, then we're protected because one's going up and one's going down. There are very few market events that cause correlation to the upside. There's not much that can happen that every single stock gets bid up all at the same time in a single day. So one example where that might happen is I'm trying to think of one, but it's just so rare. Let's just say the US government announces that it's going to start buying the government, let's say the Fed. The Fed decides to support the US stock market, and it says that we're just going to start buying the S&P index. We're going to prop up the S&P index. We're going to start buying. That would send all stocks up, especially the ones in the S&P 500. So then we start getting correlation. Instead of this becoming 1 to negative 77, it starts becoming 1 to 0.2, 1 to 0.5. The longer it goes, the more we squeeze this into 1 and 1. The opposite is true. If we hit COVID, then it's not going to be 1 and negative 77 again. It's going to be negative 1. There you're going to start squeezing together. That's what happened on COVID. Every single stock dropped at the same time. So when I have a pair, what happens is this one, even though we're starting to get squeezed, at the beginning, we still had quite a big of a spread. And this one that falls will make money a lot faster than the one that had the positive number. And then the opposite is true. If we had that weird event that caused everything to skyrocket, then the one that was going up would make money faster than the one that has the negative number. But on normal times, we expect that the two to continue to deviate, one to perform better than the other, and they go in opposite directions. That spread gets bigger and bigger, and I make more and more money as time goes on. But either way, as long as the relationship holds, then we make money. The only way it doesn't make money is if they start turning in. Allstate gets weaker and weaker, and Invesco gets stronger and stronger. That's the only way we lose money. And given how weak that they're in the same sector, it's unlikely that they're going to flip around. Both of them are going to flip around at the same time. What's more likely is they're going to start heading in the same direction at the same time. But again, we'll make money in one faster than we lose money in the other one. So I kind of like this. I'm going to say that I was going to do an example of, hey, a $1 move to the positive side, how the pair looks, and a dollar move in the S&P to the negative side, how the pair looks. But we're running out of time. We're only 5 minutes before they open. So let me just put in the IVZ. We wanted 6 of these, 7 of these. So let's put in 7 and save that. And then we'll put in our Allstate and Allstate. And we'll put in our one Allstate and save that, paired with IVZ. And that will be it. So we have 4 minutes before the market opens. Sorry for going a little long today, but let's prepare for the open, and I will see you guys tomorrow. No, not tomorrow, after market.